Welcome back folks to the ETF Masterclass. In the last video, we discussed what are ETFs, how are they different from mutual funds. We also talked about NAV and iNAV, and we touched a bit on the history of ETFs and the landscape of ETFs in India. In this video, we'll help you understand how trading in ETFs work and some important concepts of ETF liquidity, as well as we'll talk about tracking error and tracking difference. This video would be slightly technical, so please bear with me because understanding these concepts would be vital for the future videos. To understand how ETFs work, let's first see who all are involved in the process. Number one, sponsor. Sponsors are the entities who issue and manage the ETFs. Generally, asset management companies or AMCs are the sponsors. Number two, authorized participants or APs. These are also called market makers. These are exchange participants that provide liquidity to facilitate trading in the ETF. APs can buy or sell directly from the AMC in creation unit sizes. Now, what is creation unit? Creation unit is a block of ETF shares and it is predefined by the ETF issuer. For example, creation unit of Nippon India Nifty Pharma ETF is 75,000 units. This means that if you have 75,000 units of this ETF, you can directly sell to Nippon India at NAV. If you want to buy directly from the AMC itself, you will need to buy in lot sizes of 75,000 units. As mentioned earlier, ETFs can be bought and sold on the stock exchanges, just like stocks. The diagram shows how the process works while buying and selling ETFs. If you wish to buy some ETFs, you need to put in a request to buy, and the authorized participant or the market maker will give you the shares. And when you want to cash out, you put in a sell order and get cash in return, just like in stocks. The main difference between an ETF and single stocks is that ETFs are a bundle of stocks, and the value of an ETF is derived from the collective value of all the stocks in that ETF. The value of an ETF is defined using a NAV and an iNAV. We discussed that in the last video. Now, the market price of an ETF can change depending on how many people want to buy or sell it. If the price is higher than the iNAV, it is called a premium. And if it is lower than the iNAV, it's called a discount. Now, what happens when the price of an ETF deviates significantly from its true value, which is the NAV? This is where authorized participants or market makers come in quickly to take advantage of the premium or the discount to bring the price back in line with the NAV. This process is called arbitrage. The whole process of arbitrage is slightly technical, so I won't go into the details in this video. We have put a link to the blog which explains this process in a lot more detail in case you wish to find out. Now let's turn focus to ETF liquidity. Liquidity refers to how easy it is to buy or sell a certain investment. When an investment has high liquidity, that means that there are many buyers and sellers, making it easy and quick to buy or sell at the current market price. When an investment has low liquidity, that means that there are lesser number of buyers and sellers, which might make it hard to buy or sell. In this case, the price at which you transact might be significantly different from the market price. If ETFs are not very liquid, you might have difficulty in buying or selling them, and you might end up paying more or getting less than you should have. Market makers make ETFs more liquid, hence making it easier to buy and sell them. The more market makers there are, the more liquid the ETFs will be. Now, there are three factors that impact ETF liquidity. Number one, liquidity of the underlying securities. ETFs that invest in underlying securities that are liquid and actively traded will be much more liquid than ETFs that invest in underlying securities that are illiquid. This is the primary reason that the ETFs tracking the large cap indices have the highest liquidity. Bond ETFs and small cap ETFs tend to have lower liquidity. Number two, domicile of the underlying security. If the underlying securities of the ETF are domestic, that ETF will be more liquid as compared to an ETF holding foreign securities. everything else remaining same. Number 3, the trading volume of the ETF itself. One of the factors that affects the ETF liquidity is the trading volume, which simply means the number of shares bought and sold over a certain period of time. If a lot of shares of ETFs are being bought and sold, it is considered liquid. Liquidity should be one of the topmost criteria before we select an ETF. We will revisit this and discuss in more detail when we talk about the framework to select the best ETFs. Now let's have a look at one more very important concept: ETF tracking error. Remember, most of the ETFs are set up to track an index. Nifty Bees tracks the popular Nifty 50 index. Tracking error is the measure of divergence of the performance of an ETF with respect to its benchmark. In case of Nifty Bees, the benchmark is the Nifty 50 Total Return Index. Tracking error gives a sense of how good or bad the ETF has been in tracking its benchmark's performance. A lower tracking error is good and a high tracking error is quite bad. So investors should look for ETFs that have the lowest tracking error. However, investors should be careful of not using tracking error as the sole metric to choose an ETF. At the end of the day, the investors are concerned with the final return. In an ETF, the return will always lag the index it tracks. Tracking error may not completely capture the magnitude of this lag. Now, tracking difference is the metric that correctly captures the magnitude of this lag. For example, if an ETF tracking the Nifty 50 Total Return Index has returned 14.3% in the last 5 years, and the Nifty 50 Total Return Index has returned 15.9% in the last 5 years, then the tracking error is 1.6%. The broader point is that investors should look at both tracking error and tracking difference, and perhaps give more importance to tracking difference. Tracking difference can be calculated over any time period, last 1 year, last 5 years, and so on. We will revisit this when we look at the framework to select the best ETFs. Hope this video was not too technical, but the concepts covered are extremely important, and understanding these concepts will help you as an investor to choose the right ETFs. That's it for this video, folks. We'll see you in the next one.